just a brief recap, what we have learned so far is in the recent trend, in the recent few years, we have seen more corporate actions that is being scrutinized by auditors, regulators regularly. So, if you are taking any corporate action, if the company is taking any corporate actions, you need to be very versed by how it will impact my the share-based payment scheme, my expenses, and accordingly how it impact my employees. Secondly, we have also learned what is the treatment of modification, what is the treatment of cancellation and settlement, and how to treat a reclassification from cash to equity. And thirdly, we have, as Kashish has shown, a volatility trend in the listed peers of range of between 2,000 crores and 10,000 crores valuation is roughly around 40 to 50%. And similarly, for the private listed companies, sorry, private companies, the volatility is also tends to be in a similar range. So now the floor is open for Q&A. If you have any concerns or any questions, that we can help you out. Okay. There is one question that is there any cost in extension of expiry date post vesting and no other term has changed? Um, is there any cost in extension of the expiry date? I mean, if you are increasing the maturity term of the options, right? So in case you are increasing the maturity term of the option, your ultimately fair value of the option is getting increased. That is, it is giving the employee more opportunity to exercise the options. So since it is increasing the options, it is a modification, and hence it has to be booked at the modification date. So I think that is, and there is another question. What if the listed comparable which we take as proxy for unlisted are thinly traded, as you have recommended to take the volatility of low market cap listed? So, right, as the standard also said that if it is a private company or a newly listed companies which do not have comparable companies, so what we can do is we can see their the as a industry as a whole indices, and sometimes company do internal valuations also by say merchant bank, and see what is the price jump is there, what is the volatility in those prices. So taking into consideration all these factors, the if listed comparables are not there, then we can see the industry as a whole and see that, considering that as a benchmark, decide what is the best volatility assumption that the company is it can apply to. Now, so um, in extension to that, one additional point is, wouldn't the volatility be understated in that case? No. So when we are say doing the valuation for an unlisted company, we tend to consider a markup on what we are getting. For example, if listed comparable companies give us a volatility of say 30%, okay, we cannot directly take 30% as a volatility assumption for say the private company. What we need to account is what is the business nature of the private company, what is the revenue nature of the private company, what is the business projection of the private company, what how stable is the revenue is for the private company. If it is not stable, if it is not if it is newly listed, if it is newly formed, then the volatility tends to be on a higher side. So there is a markup. So say 30% can be treated as 45, 50%. So that is not an undervaluation. If we are considering 30%, 20%, that is an undervaluation. So that is the pitfall that we need to be aware of when we are deciding the volatility assumption. And the there is one more question that whether the extension of expiry date post vesting. Earlier cost was all. So even if the options are vested, um, and you are changing the expiry date of the option, you are giving the option holder the chance to exercise it for a longer period. Now the duration has increased. Now since the duration has increased, it has increased the fair value, and hence even though it has vested, the modification is still required and the incremental needs to be assessed. So we have noted down all the queries. We will just jot it down, and again we'll drop you a mail in couple of days along sharing this PPT and any in the Q&A part. Thank you, everyone.
Thank you.